Hello, West Pacific Market Analytics, and it's Glenn here coming at you. I had a quick video I wanted to do here called Paper Promises, the Looming Crisis, and this fault line showing in the global economy. And this involves actually the currency market. And I wanted to share this with you because I've been working on this for a couple of weeks now, really thinking about what's coming. And what's coming is a liquidity crisis. Now, it's not just so much a liquidity crisis, but it's going to be about the velocity of said liquidity. A liquidity crisis can get dangerous because what is a liquidity crisis? We already see this ongoing right now in the commercial real estate market. Properties are selling at discounts that have never been seen in history. It's an absolute disaster out there. It's basically just trying to offload these properties to whoever you can find to buy them. And even then, that's going to become difficult. So when we talk about a liquidity crisis, we're talking about this spiral, this loop, where you have something to sell, but you need somebody else to be on the other side of the bid. You need a buyer. Now understand what I'm saying there. That would include everything. Your house, a car, your gold. And I'm not talking about all your gold. I know gold bugs out there. You always want to hold a percentage of your money in gold and forget about price. But understand the gold you hold is going to go down in value. And so you only want to hold so much. So if you built your position too large, you might want to consider taking some profits on it. Bitcoin, stocks, Nvidia, $4 trillion. You got to find a buyer. And at some point, this liquidity is going to get tighter and tighter going forward. The liquidity is going to begin to see velocity speed up. And I've talked to you about this idea of velocity, this idea of curves or the directional circulation of the velocity of the momentum. And this velocity is going to speed up as time moves forward. Now, I brought up a concept that I was talking about an idea that the Fed does not control time. The Fed doesn't own time. All the Fed can do is buy time. And even then, the technical model, the long-term cyclical model of time will still dictate above all. And so as we get into this, I want to remind everyone that watches West Pacific Market Analytics, we're learning not to have an opinion because the only opinion that matters is the data. And there's simply too much talk out there, especially into what's coming, into what lies ahead. And we're going to understand it here. And I'm getting all this data ready simply for what is coming. So let's dive into this short little presentation and let's talk about what I mean here. The disclaimer, these charts and updates are educational entertainment purposes. Please read it. All right, let's go. So let's look. I put these here in our commodity section here on the member site. And again, if you want to get a hold of me and talk about that, I put my email up on some of these other videos and you can get a hold of me. So let's not get into that right now. Let's just go here. So here we go. Let's start with this first model here around the commodity complex. And let's start out with this comment. Economic growth concerns. However, a steep commodity price decline may signal weakening global demand, e.g., a slowing Chinese economy, for instance, which can weigh on cyclical stocks like in the industrials and the materials, and also the broader market indexes. So let's look at the commodity complex here. You'll notice going all the way back here till 2000, we had plenty of velocity we had the markets down here, right? We had gold down here. And I'll talk about what each component of commodity we're looking at here. And then we had commodities themselves, which are these blue lines, the lighter blue line you see, which is right here right now. So you notice commodities, real assets, were trading well above stocks. Gold up here was trading well above stocks in this period of 2009 to 2016. Oil was trading up here, energy. And the red line is what we're modeling, and this is a currency-based indicator. Notice that currency-based indicator the entire time into 2016 was above. And then notice what happened here in 2015, 2016. This commodity-based currency indicator came together with stocks, came together with the commodity complex, came together with crude oil, came together with oil. They all came together. And then notice that that dollar-based index went down and collapsed while everything else rose. But it could rise because it was most likely anticipating. Notice we still had the directional circulation of the velocity of momentum still rising here as we had a currency-based indicator collapse. And then notice now we've got a top out right here in 2024. And we're now rolled over, starting to roll over here in the indicator. And now we've got a bear cross back here, and now we've got our V channel starting to move down. You notice the bear cross right here. So the whole commodity complex is topping out. Now when I hear these ideas of higher gold and higher commodities in general, I say, no, that's wrong. It's not my opinion. It's right here. Now, this doesn't mean this is just going to collapse overnight. It could. I mean, we could have big moves down, and then we get a rally back up. But all I'm trying to show you in this first model of the commodity complex is we have a topping formation in play. Now let's go to something that's important. What fuels commodities? And at the same time, what even fuels stocks? And that's inflation. And boy, we had a lot of inflation in the last 17 years, going from no debt to almost 40 trillion. And in this model, we can see at last, again, the curve of the directional circulation of velocity topping out right here. Topped out in June. In the red indicator, we had this big sell-off in the market, but you could see that we still had not topped out in inflation. So notice this top out inflation, how long this is taking here. And now we are rolling over and heading back down. Now you notice we got this initial close on the signal here, which will allow us to drop and start down into the V channel. And you notice that the signal opened all the way back here when we began this big rally up. So we're seeing a trend change ongoing here within inflation, which would take us into a liquidity event ahead, and a liquidity event would be deflationary. So let's continue to look at this inflation model. We can see here lots of liquidity, not so much liquidity, but remember we're measuring the velocity of liquidity. So actually what this blue is measuring is not liquidity itself, it's actually measuring the velocity of liquidity. And to me that's more important than the actual liquidity, because you can create liquidity just like you can print money, but can you create velocity of that money? Well, it's the same concept. If you print money, can you create velocity of liquidity? The velocity of liquidity or velocity of money are two different things, but they work with the same concept. You have to be able to create the velocity into money printing or create that liquidity. And you can see every time we had liquidity drains, the market sold off. Here's a liquidity drain and the small sell-off here back in 2018. Here's the next one here in 2019. And then notice liquidity, velocity of liquidity spiked up again. And then there's our move down in 2020. Pretty deep move, you see it? And the red line came down. And so pay attention, the red line went down, okay? And then notice here's our 2022 move coming down as velocity drain. So this is our second largest velocity drain after this one. And then we had a third velocity drain here, but notice we were able to float across it this time. And that could happen because there's other technicals besides one chart. And notice now we've got a velocity drain beginning pretty aggressively right here, starting off of this first move down in April. Then notice that first move down in April in the market, the velocity was not draining, as we saw in this model right here, right? So you see, the velocity is not draining in this model here, and the velocity is still not draining here, because you see the red indicator? But that should change pretty quickly now because we can see the drain ongoing here in the actual velocity of liquidity. So we're going to be watching this because this is really important. Here's a closer up of it. You notice the red indicator, if we get in closer, we can see we still got to move down here. And we had, the market was weak. You notice it reacted a bit late here in that late 2023 sell-off. But then look how the liquidity built right back up. And now it's draining again here on the other side. This was a much larger liquidity spike than what we had back here in 22 and late 22-23. So that's a very important because the price of everything is based on them still being able to create inflation. That's why the Fed loves inflation. Don't be fooled. You don't have any money, you need deflation, but the Fed doesn't care about you. They only care about keeping all this debt alive. And the only way to keep all this debt alive and continue to sell bonds is to continue to have inflation. But what's really interesting here is this idea of what I call the pink to black signal. Now let's look at that in just a moment. This is the same model. We're looking at inflation. So notice back here, the red indicator in 97 to 2000, we had this corrective move. We had inflation draining, market topped, and then it finally drained in the 2000 corrective move. You see it in blue here? So we had a little bit of inflationary spike, and then it all moved lower. You can see right here moving down with a V channel. And then again here in 2007, look at that huge drain in liquidity. The red and the market both tumbling quickly together. Now notice what happened here. The red indicator hit this pink line. Now there's a rule in the model that once we hit the pink line, that we then have to go up and hit this black line above. And notice right up here, here's that first corrective move, right? We're topping out right here. You see how we're hitting up here on the black line? We can't go any higher. This is a finishing move. I call it the pink to black rule. And now you can see here that liquidity, let's pull in on this little top. You can see liquidity starting to drain, trend starting to drain. We want to see how quick this could break down. So we're watching that. We're really, really watching that close. Now let's go to the next idea. We talked about a slowing Chinese economy. Now 45% of this index is allocated to the Chinese financial sector. Okay, let's not look at this US here. Let's look at this. So here's this Chinese market draining. So imagine this is 45% financials, and Chinese, the real estate market is going to be really key to things, not only in China. In China, they really love owning property. And in America, real estate is the driver, it is an economic engine too. It's a driver of the economic engine all over the place because it really drives consumption. And for sure it drives jobs. So we can see coming out of 2018 as the market was rallying up in the US, and that could have been some money rotation as well out of Europe, right? Because China was in a bear market from here all the way down to here, and it finally bottomed. We had an initial bottom here in 2022, and that was the low, timed here with the low with the US. And then we had that second bottom in the US and a second bottom here in 2024, right at the start of the year. You see that? And then we had this big rally up. And then notice with this rally, the US rallied up too. But that doesn't mean now that if China is going to go back down, that the US is going to keep going higher. Absolutely not. The US is extremely overvalued now because it was undervalued here to China. It was equal value here. It was fair value here. And now it is expensive. Even here, China's cheap compared to the U.S. up here. And the U.S. has got as much problems as anywhere else. Now notice we're coming up here to test the top of the dot curve. You notice the directional topped out in China back in 2021. You notice the V channel. We're very nicely here in the V channel, so it's priced okay. But in my opinion, China is now ready to start heading back lower. So we're going to be watching China. And if we go to the second China model, it gets a little more scary, because this is zooming in on it. And you can see that China's topped out right on its liquidity right here. Look at this. You notice how it's coming right down the velocity channel this entire time. And you notice it was way up here in 2021 as the American market came up. They all came together at the 2022 top. They both sold off together. And then the U.S. market started to move up. The Chinese market continued down and it bottomed. And then out of that bottom, both China and the U.S. rallied. But look, China's done here. Take a look at a close-up of this. 1, 2, 3. Look at that nice triple top on the channel above here off of the low. Here's our low of this particular move. Way down there. Now we got a nice triple top, and look at that, right at draining liquidity. So if we take that draining liquidity here, look, here is, let's snap back out. Here's the rest of the year into year-end 2026. This is ready to start moving down. And that means we can't be up here. So China looks set, right, to start moving lower. Now let's talk about Japan. Let's talk about another driver in this whole liquidity scenario. What creates liquidity? Well, the carry trade. It's created so much liquidity out of the 2009 low. It's been a vehicle that, in a way, the Fed has used the Bank of Japan, and they bankrupted Japan in the process. Because, it's a great trade to borrow in yen and buy in dollars, and that's the carry trade. But what happens when the carry trade unwinds? And that's a good question, because the carry trade unwind, if the global markets turn volatile, then investors will unwind these trades. They'll start buying back the Japanese yen and increasing the demand for US dollars as a safe haven, and actually causing both to rise against other currencies. So we could see actually not the dollar going lower, but we could see the dollar and the yen both going higher. Now, a higher yen is definitely not bullish for the U.S. markets. And the dollar going up would just be a flight to liquidity, because all of that, right now we've got the money market funds at historic all-time record lows. So as people begin to sell things, that money either has to go into cash or into treasuries. Now, a lot of that's not going to go into treasuries. They're just going to park it. And there's going to become a shortage and a demand for dollars, because it's still the reserve currency. So again, we see this idea of pink to black in the carry trade model. And look at the velocity just coming out here as this is hanging out like a thread here. See it here? So when we look at the US JPY pairing, or the carry trade, while both currencies can rise against other currencies, their relative value, the exchange rate, depends on which is in higher demand. For example, if safe haven flows favor JPY more, the US dollar JPY may fall as the yen strengthens relative to the dollar. So this, having a rising yen, would not only cause the market to collapse, and I didn't include that model, but that's a great model as well, but the yen would rise and this would collapse. And notice that signal, how we're just, this last rally we had, notice how we started to collapse and they stopped it. And look how it's all just kind of got this diamond-y looking formation up here. Head and shoulders, diamond-y looking formation. This pink to black completed formation up here. And it's ready. The carry trade is absolutely ready to unwind. Now let's talk about the market sentiment side of it. Market sentiment, the degree of risk aversion matters, because extreme crises like when we had the 2008 financial crisis, they'll often boost both currencies, which could rise together. If global markets are reacting to a major event, a geopolitical tensions, I think we have plenty of geopolitical tensions, and we got the Shanghai meeting going on right now where all the BRICS nations are meeting out in China. as we speak. The meeting's ongoing. It ends today, the SCO. And so, yes, there's real issues there. So, we could get into a geopolitical tension. We could get a stock market correction. We could get escalating U.S.-China trade chances, or we could even get a European banking stress. And boy, doesn't that fit into the picture when just this week we had France come out and say we need a bailout from the IMF. France, of all countries. So safe haven flows could lift both the U.S. dollar and the Japanese yen, because nobody's going to want to hold euro in a European confidence deal. And if China is in trouble because of trade tensions, it's not going to help them. Right? So again, you see that? Pink to black again in another model. Now let's go to the U.S. dollar and finish with it. I think everybody is calling for a collapse in the dollar is absolutely wrong. That's a story for later. At some point, into ending cycle, as I've talked to you about the ending 300-year cycle around 2076, that's another story. But we can see this beautiful, look at this going all the way back here to 1986, 87, when we had 86, 87, right? We had that crisis there in 87, that Black Monday. But look at this nice, look at this hit here. Hit here, hit here. Pink line hit right at the low of this beautiful looking lower cup formation here. A hit here, and then a hit here. So we got 1, 2, 3 hits, and we got 1, 2, 3 hits on the left side, and now we've got a handle formation in play. Now remember the rule, pink to black. That's saying the dollar has to go here. Now look on the left side of the model. Look when the dollar collapsed from here down to here in a huge move. That's saying we're going to get a huge spike in the dollar to mirror this from here to here, because we have to go from pink to black. I think once we come out of this handle, and we'll see how this develops and if this theory is right, but I'm pretty confident it is right, we're going to see the dollar take off in the next couple of years. And if we get the dollar take off, what do you think that's going to do to the commodity complex? Cut gold in half. Well, I hope you enjoyed that. Hit the like, hit the subscribe. Watch this a few times and think about what I'm saying here. And I've got a ton more data coming at you. Thanks for tuning in. Have a great Labor Day weekend. It's Sunday. Bless you, your families, your loved ones in health and happiness. And thanks for tuning in. Glenn's out.